welcome everybody. So today is Tuesday, March 4th, 2025. My name is Jim Denholm. I'm founder and CEO of Ironbridge Private Wealth. We've been wanting to put out some reports this year. We're looking at a 25 outlook, and frankly, with the uncertainties coming out of Washington, there's just a lot of moving parts. So it seems like if we were going to write something, it doesn't have a real long shelf life. And I don't know how long this of a shelf life this webinar is going to have. Frankly, we hope the things that we're looking at and discussing can last a little while. But this is the kind of environment where we need to be very nimble. We need to be very sort of diplomatic, if you will, and almost like a mercenary, where we try to fight for the winning side. It's choppy right now, so let's go through and look at things. We'll look at the S&P 500. We've had some conversations recently with clients, and it definitely feels, the market environment feels much worse than it actually is. I'm going to talk about government corruption a little bit. That's a lot to potentially see. The GDP impact. I think we might be expected to be a little bit shocked with some of the things that come out. I don't want to overplay that, but we're going to look at kind of a range of scenarios and then how to handle uncertainty. So let's go ahead and get started. S&P 500, it feels really, really bad. But frankly, it's not terribly bad. If we look up here at the top, we're going to look at a few different things. But if we look here, this is a chart of the S&P 500 going back about a year. And if we look, this was the election, kind of right at the first of this box on the left side. This was the election. It was over. That didn't go extended. We didn't have riots. We didn't have a bunch of, kind of a messy environment after the election. Trump won, but we've been in a range ever since. So we saw this big boost following the election. We saw a bit of a sell-off kind of into January, first couple weeks of January. Kind of saw another bounce, and we've seen a dip here recently. Like I say, it feels bad, but if we look at the overall health of the market, it really isn't doing anything, terribly concerning. We've been in this range. We haven't seen any major breakdown. We really haven't made a major new low. So we've got a kind of continuing having higher lows. Here it tried to make a new low, but it's just, that's not very concerning. And if we look at some of the other things that we like to look at to be early on in the early signals to see if there's stress coming into the market or not, we're starting to see maybe a little bit of an uptick of that, but nothing to necessarily write home or be too concerned about at this point, but we definitely need to be watching it. And we talk about this quite a bit, the high yield credit spreads. So this is a good indicator of early signs of stress, especially in the big money, in the institutional investors, the hedge funds, the sovereign wealth funds. They tend to look at bonds more often. Bonds tend to be the smarter market, and looking at the difference in the yields between the risky junk bonds and the safe treasury bonds, that spread, that difference in yield is what we like to look at. And when there's stress in the market, you can really see those spreads kind of blow out. We've seen that a few times. If we look back last summer, there was some kind of technical trading environment from the Japanese yen devaluation. There was a carry trade unwind. And if we look at that scenario, we had about a 10% pullback, almost a 10% pullback. And we saw a pretty nice little spike higher in the credit spreads. Now we've seen sort of a couple 5 and 6% drops. We're only about 6.5% from the all-time high. S&P's down 2% year to date. It feels so much worse than that. It feels like it's a market that's down 10 or 15 or even 20%. Frankly, I think y'all might feel that too. We're going to address that. Credit spreads have ticked up over here on the right side of the chart, but it's just to a place that it was at the first of the year. So it's not giving us any real warning signs. If it does start to creep a little bit higher, maybe we start to see a break of this kind of lower stable trend. and we need to watch, see how high yield bonds react. But we need to keep our eye on it, but it's not terribly concerning. Advanced decline line. So this is another way to look at sort of breadth in the market. And advanced decline just looks at the total number of stocks that went up today versus the total number that went down. And then it's just a cumulative line. So it just adds up. If there's more advancers than decliners, this line goes up. If there's more decliners than advancers, this line goes down. So it's a kind of a visual way to see how many positions, how many stocks under the surface of the market are making new highs, are going up on a daily basis versus going down on a daily basis. And what we see with the advanced decline line, it's kind of a nice chug higher over time. We flattened out a little bit. We had a little bit more of a decline kind of late December with this pullback. Latest pullback here, we just haven't seen that much. So despite it feeling a little bit scary, a little uncertain on the surface, when we look under the surface, things are actually relatively calm. So let's look at why it feels worse than it is. So sentiment, this is one of the more interesting things that, frankly, I've come across in my career. It seems like more and more we're getting unprecedented data, but this is particularly strange because sentiment, there's three things that we look at. There's fundamental data, that's earnings, revenue, GDP, sort of the actual economics of a society or a company. The technicals, which we do like to spend a lot of time on, that looks at momentum and trend and things like that, doesn't care about revenues, just looks at the behavior of stock in the market or a market, and sentiment. And sentiment is an inverse signal, so it's a counter signal. Whenever you get a lot of optimism, it tends to be closer to a top, closer to a market top. Optimism is not a good signal. Markets can stay overly optimistic for a very long period of time. Just because there's a lot of optimism in the market does not necessarily mean that risk is high and that we're entering into a bear market. However, on the flip side of it, when bearish sentiment is extremely high, bottoms can mark a good turning point. And what we've seen, this is one of the sentiment indicators. There's a lot of different ones, but this is the American Association of Individual Investors. It's kind of your normal like retail trader like you and I that tend to do bad things at the wrong time. So it's being very pessimistic at the 2008, 2009 bear market low and selling. 87, selling at the bottom of a 25% crash in a day. The bear market in 2000, the tech bubble, selling at the bottom after a 2 or 3 year bear market. Most of these, so this spike in bearish sentiment that we've seen recently is the 7th highest spike all time. And the other times, we had on the low end of it sort of a 10 to 12% decline. On the high end of it, it was a 55% decline in 2009 when this sentiment reading hit. So, the kind of capitulation, the kind of increase in fear that we've seen right now, we would normally associate that with a low point following a pretty major bear market. And, we're 2% down for the year, kind of 6% off of all-time highs, and we've got this massive spike bearish. This by itself is a very bullish indicator. Now, if it starts to continue, if we start to have, like in 2008, we saw kind of a cluster of these really high signals, really high bearish signals that culminated in the 2009 low, March 2009. So maybe we see that right here, but more than likely when we see this sentiment, this big negative sentiment, it's actually pretty good for the market. So if we can go through a relatively minor pullback, get sentiment to kind of bearish sentiment to really blow out, that's a wall of worry that is healthy for the market to climb. So we need to keep an eye on this. But if you're feeling a little bit bad, you're not alone, and a lot of people are feeling that, which I think is kind of interesting. Um, just a little reminder: if you want to answer or ask some questions, we're happy to answer those along the way. So just type that in the Q&A. I'll keep glancing over here at my other monitor to watch for those questions. Seasonality is favorable. So, there are definitely some risks out there. There are definitely risks from Washington primarily. But if we look at the market itself, we had a higher January and a lower February. What does that mean going forward? Pretty good. 96% of the time for the full calendar year, it's positive. And on average, it's almost 20% when we see an up January and a down February. So, we need to be concerned. We don't need to be real bearish at this point. So there's still a lot of positive data that's happening. So here we saw some Fed rate cuts last year. Typically the Fed is going to cut rates when there's recessionary concerns starting to come in. We outside of the last month, we were not really concerned about a recession. We saw some risks a couple of years ago that did not play out. The GDP now, which is what we'll look at that here in a second, but had been pretty stable. And if we look at the Fed, if they cut their first cut, if this shows the market performance after the first cut on all scenarios, average, if there's not a recession and if there is a recession. So the orange is our current one. So we saw the first rate cut, 5 months ago or so, and this is what the market has done since then. Now we've seen this little fall back down right here. This was a couple weeks old, this chart. If we're not in a recession, we tend to have this kind of January, February performance, up about 20%. If we do have a recession, it's opposite. It's either flat or slightly down. Fortunately, after the first rate cut, it tends to not accelerate lower real fast. Even 2008, 2009, we had a year after the first rate cut before we saw a low point. So it's really key is if we're going to be in a recession or not. It's looking like we have increased probability of a recession. I'll get to that in a second. So if recessionary risks are increasing but not incredibly high, it's something that we need to pay attention to. Another question we get relatively often, because we are late cycle, what about valuations? Valuations are stocks are on the high end of the valuation range. People talk about valuations, talk about whether it's overvalued, undervalued. We like to look at valuations, but it's not a direct input in our model. And we came across this. This is from Carson, our friend Ryan Dietrich, who I think has just amazing charts. I love it. This shows forward 1-year returns based on the PE multiple of the S&P 500. So what that says is higher, up and down on the left side is the PE ratio. So here we're going from the chart is going from 5 to 35. And along the x-axis is performance 1 year later. So for example, if we have a 20, this line is right about a 20 PE, that's had returns everywhere from up 50 to almost minus 50 and almost everything along the way. If we shift this line up and down, we don't see a big clustering of data. You would think that if high PEs resulted in low returns 1 year out, you'd have a lot of diamonds up here in this top left quadrant, saying that uh, PEs are elevated, multiples are elevated, and we get a negative return for the following year. But frankly, the most of them are over here on these positive years. There's a lot more data to support a strong market with high valuations than a negative market with high valuations. Now, part of that is that markets trend higher over time. 4 out of 5 years are positive, 80% of the time, roughly. So we should expect that over here. But it's pretty interesting that by itself, valuations just are not a good timing tool. So, like I say, it's used to provide context, but not to provide signals. Rate cycle. So when we look at what the different bigger cycles are, we really like the cycle analysis. I'm a little bit of a market history student of market history. This is the tail that wags the dog. The interest rate cycle is very much a works in cycles. It's 30 years up, 30 years down, almost like clockwork. There's interruptions, usually from war. But what we've seen is we've saw the most recent cycle being a down cycle from 1982 to 2022. So 40-year cycle, 40 years into a 30-year cycle. The market's playing catch up. So instead of having, if this bottomed right here and sort of slowly moved higher, that's great. The Fed kept interest rates artificially low, and we played catch up. What happens, this is important to consider for a few things. One, we need to look to see if some of the structural things out of Washington could cause problems. But it's interesting to see from this chart that bonds, the interest rates have had this cycle through various different cycles of government setups. It was before the Fed. Fed was created like 1917. So going back well before the Fed, 150 years before the Fed, almost 180 years before the Fed, it was still working in those cycles. I'm not going to go into this too much, but the reason is human beings are the same. We're dealing with fancier technology. We have access to information more quickly, but we're still humans, and we're still gorillas making the same emotional mistakes. This is the kind of environment that we could make an emotional mistake, and that's why we have to have rules. So as we're looking at this, if the interest rate cycle does start pushing higher, what tends to happen is markets flatten out. Next chart, this looks at the S&P 500 currently, and then also from 1955 through 1977. So leading up, the last time we were in a rising interest rate, rising inflation cycle was in the 70s. The stock market was flat, had a 0% return from 1968 to 1982. And if we look, this pinkish purple line is the S&P 55 through 77. Here is where this chart stopped, just kind of earlier this year. This is from Fidelity. They also have some really nice charts as well. We've been moving along pretty consistently with this kind of final bull market leading into a higher interest rate cycle. So what happened after this is when the market got to this level, which is kind of where in today's world about a month ago, but in the 60s world, about 1968, this was choppy, flat, and you go all the way, this is 1974, go all the way out to 1982, and the S&P hadn't done anything. That's 14 years. And the time before this, we had a very similar environment. 15 years, very little return, 1% annual return. That was in the early 1900s. So before and after the Fed, two completely different environments, almost identical outcomes. And now we've got the market that's really rhyming quite well with the lead up to that kind of environment. So this is something we've been talking about for a year or two now, and it really does look like that's continuing to stay on this track. Trump can, the things coming out of Washington can easily throw things off. But we need to look at that rhyming, and there's a couple different reasons for that. We'll go into it a little bit more detail as it goes on, but something that we need to watch because it really is rhyming quite well. So risks. What are the risks to growth? Besides the normal stuff, we could always go through a business cycle. We've had AI is a really strong area. It looks like it still has further to go. So there's definitely the baseline is that things are stable. The market is decent. We've got these Washington risks. So what are they? Government spending, mainly a reduction of government spending because it is a fairly large part of GDP. We've got tariffs that definitely could cause economic volatility. The Fed is always a wild card. Trump has basically said that he'd like to end the Fed. I agree 100%. I'll talk about it why. Corruption, I think this is the big wild card. Some of the initial signs coming out of Washington are really not good about what's been happening. There's some estimates that 50% of the Ukraine spending was laundered basically by US bureaucrats. Massive fraud in Social Security, Medicare, US aid, obviously. And depending on how that plays out, there could be some pretty shocking revelations. There are rumors out there on social media, which I don't know, you can't ever guess how true they are or not. And it goes into a risk that we think is important right now, which is narrative risk. But there are some estimates out there that up to 25% of total government expenditures was waste, fraud, stolen, whatever you want to call it. It's pretty major. So I think we have to. This is not a partisan thing. And talking about politics, sort of transitioning into a political talk, just want to kind of lay the groundwork. We've got clients on all sides of the spectrum. This is not to promote one side or the other. Personally, I think they all should go to jail. I've thought that for 20 years. I think we might finally start seeing that. But, I don't want to sound like I'm pro-Trump, anti-Trump. I like to call it like I see it. I don't care. I'm not a Republican, not a Democrat. Like I say, I kind of think they're all crooks. But anyways, there are some major risks to growth, primarily coming out of changes that might happen out of Washington, it seems like. The economy is reflecting that. So when we look, this is something we've looked at regularly, the GDP now from the Atlanta Fed. A lot of this is surveys, so it is called soft data for a lot of this, but it's been pretty accurate. So the last couple of quarters, third and fourth quarter, there were really consensus calls that we should be heading for a recession. The Fed was starting to say that they think we're heading for a recession. That's why they cut 100 basis points last fall. But the GDP now estimates were pretty accurate. It was estimating sort of 3 to 3.5% in the fourth quarter following the election, and that was very non-consensus. The overwhelming thought is that that the Fed cutting 100 basis points was risking that there was an increased risk of recession. What we're seeing now is the estimates really fall. So we've seen almost a 5% drop in potential GDP this quarter, from up 3 to down a little over 2, up 2.5 to 3 to down 2 to 3. That's a big drop. And it's mainly because the government spending could stop and probably should stop. This is the big risk. If there's been a lot of government spending that has supported the economy, you could say that, I'm not going to argue the merits of it or not, but it's government spending is not typically real productive. You get much better sort of efficiency for dollars spent in the private sector as it relates to GDP versus the government sector, the public sector as it relates to GDP. So for every dollar spent, there's a higher translation to GDP dollars, the cents on the dollar, if that makes sense. But so it's not going to have a one-to-one effect, but it definitely will have an effect. This is a reflection of poor sentiment as well, because most of these surveys are soft data surveys, so kind of people's feelings towards it. But this is an important thing to watch, and it could justify more of a risk reduction for portfolios. I'm going to just kind of look at some questions over here. I don't really see any. I'm going to make sure that I'm looking at everything right. Okay. Tariffs. So I'm not going to read this whole thing. Just want to use this really as a reference, because it is an important piece. Tariffs are being implemented, and there's a few thoughts on this. One is if you take all things being equal, tariffs are typically not good. Tariffs, although it seems right now that tariffs are not being used in isolation. This is part of the difficulty in this environment, and it's part of one of the things that's important in this time is to not get sort of tied down to predictions. If you think that things are going to be bad, and you sort of stand in and really stand your ground on that, for maybe it's because you don't like Trump, that's not a good way to approach it, because there are very bullish scenarios that could happen after this. On the flip side of it, if you're pro-Trump, don't think that everything is going to be rosy because of this. It could be, but the devil's in the details, and there could be a very big misstep with all these things. Bottom line, I kind of think we're going to see a little bit of volatility until we get some clarity on what this looks like. But generally speaking, tariffs, well, okay, so I'm going to try to summarize how I understand the situation. The reason for the tariffs is really twofold. One is a fairness, but I don't think that's as big of an issue. The Trump administration, including Bessent, the Treasury Secretary, have multiple times said that they want to eliminate the IRS. And in order to do that, there has to be a revenue swap. So if there was a reduction or an elimination in income taxes, there would have to be some sort of increase in revenue elsewhere. So if there's enough fraud and waste and abuse that the budget can be crunched down, start to implement tariffs that this tax organization estimates that 700 billion annually of tax revenue can be generated from tariffs. That'd be a 20% across the board tariff and a 60% tariff on China, which would be the kind of the net sort of conventional 25% potentially on Canada and Mexico, although, we'll have to see how that plays out. Income taxes generate 2.5 trillion or 2.9 trillion or 2.5 trillion. There's 2.9 trillion of goods that the tariffs would apply to. So if you assume that there's no change in consumption, no change in trade, which is a dangerous assumption, then you get a 700 billion inflow potential annually from tariffs. The proposal is to replace the income tax with two different revenue sources. One would be the ERS, an external revenue service that would handle the tariffs. And the other proposal from the Treasury Secretary would be a national sales tax administered by the states. This is very early in the process, legislative process, but it does not look like it's just some campaign promise. It really looks like there is a pretty big delegation in Washington that includes the president, the vice president, the cabinet, the treasury, probably everybody but the Fed, to eliminate the IRS. Haven't thought about that one in a while. So, that's going to be a big one. But if we think through that, what would the obvious signs be? Well, one, economic activity should be pretty darn good. If there's an elimination of personal income taxes, that's an immediate, benefit for just about everybody in the country. And given where debt loads are, given where savings levels are, I think that would probably almost go entirely to spending. And so that could be a really big boost to GDP, especially if private sector, every dollar in the private sector, every dollar spent in the private sector has a higher percentage trickle down to GDP than government spending. So you could have a bigger drop from the government spending and a smaller increase in private spending, and that could keep GDP at pretty consistent levels. If there is a lot of just theft and these politicians, both sides of the aisle, if they've been doing what it looks like we're finding out that they've been doing, which is stealing billions and billions of dollars, frankly, it makes me pretty mad. And especially when they want more income tax, if they've been stealing it, I think we really have a societal problem. But from a GDP standpoint, it's much more nuanced than that. It's not. It seems they are taking a big hammer, a sledgehammer to the spending, but when it comes to GDP, I think there are some more nuanced approaches that we need to look at, not just, government spending is down, so GDP is going to be disastrous. It's going to take a hit, and there's going to be a lot of unintended consequences from this. We don't know all the answers, but understanding and identifying how these different things play out, I think are going to be incredibly important over the next few months and next maybe year or two before the midterms. But it has really long lasting impacts. So I think we need to be agile and we need to just be very, very, very objective. But if they did have this tariff combination with sales tax, it could cover the drop in personal income tax. The state of Texas has 84% of its revenue from sales taxes. No income tax, property tax, sales tax, but sales tax is 84%. Texas is in pretty good shape. If you do that with the US, you've got 84% that could be sales taxes and maybe 16% or 20% are tariffs. So it's really not out. It's not crazy. No matter what you think about Trump, he might be crazy, but this proposal really isn't crazy. We have to see how it plays out. Still looking for questions. I don't know that we have any just yet. I kind of thought we might be getting some right there. But so we need to pay attention to these tariffs and the income tax. The Fed, this is another big one that could affect the investment landscape. The initial reaction, again, is that you hear about, oh, they want to get rid of the Fed. Well, that must be crazy. Not really. I've said for probably 20 years, I think the Fed creates more problems than solutions. And if you look, this is kind of an old chart from last year. But what it shows is the black line here is the Fed funds rate. The green line is the 2-year Treasury yield. And what happens is the Fed, they've got all these 400 PhDs. They're supposed to be the smartest people on the planet. All they do is follow the 2-year Treasury. And when they don't, when they are too smart, when they're smarter than the 2-year Treasury, they cause problems. So in the 90s, they consistently kept things accommodative, where the Fed funds rate was lower for the most part than the 2-year Treasury. This drop in the 2-year Treasury was the long-term capital management collapse. There's a little bit mini recession. Fed cut, 75 basis points. We saw the tech bubble really accelerate, and the Fed lagged. So you see this gap underneath here. That's the Fed keeping financial conditions looser than they should. So they kept financial conditions looser in the late 90s, fueled the tech bubble. Then they kept things restrictive for too long. The 2-year Treasury started to move, about 6-7 months before the Fed did. That created a restrictive financial conditions. So, companies can't get market rates. The Fed rate is higher than market rates. So they're keeping interest rates artificially high. Then you get down to the low point in 03, the 2-year Treasury starts to go up. And again, have this big gap. They waited 6-7 months and then were perpetually behind, catching up to the 2-year Treasury. This loose financial conditions where the Fed funds is under the 2-year Treasury, that created the tech bubble. The real estate bubble. The combination back here and especially in here created the real estate bubble. Then the 2-year Treasury started to decline and the Fed was late. So then we kept the interest rates at zero for this decade in a loose financial condition. So people could get loans. The Fed funds rate was lower than the 2-year Treasury. So you could get loans that were cheaper than what you should have been able to get. This goes back since its inception. The Fed consistently causes problems. It should be eliminated. However, the market is extremely dependent on the Fed. And it's devil's in the details. Eliminating it would be very positive, but it's between here and there that we'll have to see. One last thing with the Fed is I'm going to go back to this chart. The Fed was created about right here. And if we kind of draw a line right here, just to the left of this 1920 and go backwards, inflation was self-correcting. This is the real big inflation spike, but it self-corrected within, a decade, a few years. And the range was not that high. You pretty much had inflation kind of go 5 to 8% pretty consistently over 150, 180 years, almost 200 years. Then the Fed comes in, and granted that's World War II, but interest rates, because of the Fed, go way below what they had historically. Then because they kept things too low, they created inflation and had to go put rates up to almost 16%. And I know a lot of y'all remember that with your first mortgage at 16 or 18%. And then we've seen this massive collapse in deflation over this 40 years. So they've just had, instead of having more normal, shorter, logical cycles, they create instability. And the instability is not created in a short period of time. The market would appear more unstable on a short period, but it's actually more stable on a longer period. With the Fed, it's more stable on a short period, but less stable overall, if that makes sense. So bottom line is 100% I'm in favor of getting rid of the Fed. It would be messy, and we would have to really, really pay attention to different things on that. So there's the Fed. Outcome ranges. We're kind of finishing up here. Few different analogies that we made, and when we look at the potential outcomes of this scenario, one of the quotes that I love from Shakespeare is, something about being on the stage of life and full of sound and fury, signifying nothing. Seems pretty good. So a bearish scenario is that the things out of Washington are true and it's bad, that there's been massive corruption that would be very, very difficult to wrap our heads around. This Carl Sagan quote, I think, is kind of interesting. One of the saddest lessons of history is this: if we've been bamboozled long enough, we tend to reject any evidence of the bamboozle. We're no longer interested in finding out the truth. The bamboozle has captured us. It's simply too painful to acknowledge, even to ourselves, that we've been taken. Once you give a charlatan power over you, you almost never get it back. So that might sound a little bit extreme, but I do think that there are outcomes from Washington that we need to be prepared for being extremely bad. And that would result in cash. And that is a scenario that I think is increasing in probability as the days go on. On the flip side of it, over here for a bullish scenario, the signifying nothing. If for the people that don't like Trump will like this, but he's a blowhard. And, part of the negotiating tactics that he has is wants to go, extreme one side so that you can get the advantage and tilt the advantage to your side. And he could be doing this by having some major things that he wants to get accomplished. I tend to not think so. I tend to think that there's been a consistency in the bigger potential things like the getting rid of the Fed, getting rid of the IRS. I don't think those are signifying nothing. Now, they might not come to anything. So that would be a trend where there's a lot of concern about things changing, but not that much really changes. Maybe there's a little bit of fraud, and the truth is going to most likely be somewhere in the middle. It's not as bad as some people are predicting. It's worse than a lot of people think, but it's not a completely destructive environment. So like I say, kind of the majority of this is kind of in the middle, but we should expect a confusing environment. Narrative risk is something that we think we're going to talk about that more and more over the next year or two. But with the advent of AI, with these sort of ingrained, entrenched right versus left, manipulation of thought, and it's just a confusing environment, and we can't necessarily believe everything that we say or that we hear, especially from the big news. So this narrative risk is really high. What that means is we just have to look at data. And when we look at uncertainty, you have to stay nimble and you have to look at data. You can't, it's easy to be fooled. So, looking at those scenarios, we need to be in a position to expect anything. Starting to get some questions here. So let me go ahead and answer some of these. First one, why is it bad for the market if massive corruption is uncovered? I thought it would be good to clean up the corruption and wasteful spending. Great question. Yes, it will be, I think, a reset of expenditures, getting rid of waste, prosecuting people, Republican or Democrat, that were stealing money from the American taxpayer for their own personal gain, throw them in jail. The long run is good. That is a necessary thing to avoid bankruptcy for the country. There's 75 trillion of unfunded liabilities, promises that the US government has made that are not realized yet. So, in the form of future Social Security payments, future Medicare payments. So we're not just dealing with a $36 trillion debt. We've got another 75 trillion of unfunded liabilities over the next 50 years. That's, it's bad if we don't do anything. The Fed has printed so much money over the last 15 years that the economy and the market has been sort of insulated from it all, but it's real, and it has real risk. So when I look at the bearish scenario, I look at that bearish scenario being the worst scenario the soonest. So if we look at worst case scenario, it is, every conspiracy theory you've ever heard of is true. So the CIA killed JFK, killed RFK, did 9/11, all that stuff, with massive corruption that basically just, the reason it would be so bearish is it crumbles the trust in institutions, not only across the country, but across the world potentially. So the crumbling of confidence is what's troubling for it. Beyond that could be very, very good, but a lot of government funds have been flowing through the economy and flowing through the financial system, and fund flows, the flow of assets, the flow of money is really what's important. It's not the levels, it's the flow. So I don't know if that really helps, but cleaning up the wasteful spending and the theft is important and will lead to a very, very good scenario going forward. Between here and there, it can be very uncertain. Good question. Right now, another question. Right now, tariffs are inflationary. So if the grand plan is as you outlined, it seems irrational to start this trade war now. Could be. When you're looking at tariffs, it can create a trade war. Tariffs are, for the most part, inflationary. I don't know that I would call it a trade war or a trade normalization. But the fact is, the US economy has by far the most output per capita. So per person, we have the highest revenue generation from a GDP perspective and the highest consumption per capita. Companies and countries want to sell into the US consumer. We have proven time and time again, we love to consume. And a lot of people know that. So when you look at the consumption patterns, a lot of that is discretionary spending. If you get the combination of an income tax reduction or elimination and tariff, I think the reason, and I'm not on the inside, I don't have any kind of, insider knowledge on this. It's just my perception from what I'm reading. It seems like those need to happen pretty quickly, because the reduction of the income tax and the reduction of a tax cost on the US economy, elimination of that friction more than compensates for increased prices in a trade war. Tariffs by itself will most likely cause a trade war. especially since so many people around the globe don't like Trump. But they do like the US dollar, they do like the US consumer. So I think the US is at a pretty good position, and I think Trump knows it and he's using it. The question is what is the ultimate outcome? Is it a good outcome or is it a bad outcome? And is it, you know, full of sound and fury, or does it signify nothing? Or is it just walk a tightrope and, everything is great? I kind of doubt that, but there's bullish scenarios for sure. Bottom line, I kind of sense that there'll be a little while for things to really take effect. And so the baseline right now is a decent market, decent economy. If the trust in the institutions start to deteriorate from arrests, very high profile arrests, then that kind of throws things off. But it's a little too early to say if the tariffs are going to be good or bad, and it could be both. Another great question. Another question just says gold, silver, et cetera, inflation scenarios. We've had gold for the last, 14, 15 months, been a really good investment. Gold has actually outperformed NVIDIA over the last year, which is sort of strange, but semiconductors have flattened out over the last 6 months, kind of been flat, really along with the market over the last, 4 to 6 months since the Fed rate cut. It depends on the inflationary pressures. If we look at the scenario without effects of changes in Washington, that scenario says we're likely headed to a rising interest rate environment. We are likely headed to increased inflation from a combination of factors. Tariffs, one; deglobalization, two; moving supply, more and more of the supply chain back to North America and back to US soil. That's inflationary. It costs more to do stuff here than it does in Asia. So the baseline assumption for us is that we've got a year or two left of a decent bull market, maybe 20, 30% higher in prices. But it's going to be like it's going to feel strange. It's going to feel bad. Lot like it has felt this year. There's big down days, big sort of public, stand out big down days in the market, and a whole bunch of little grinding higher small gains back to back to back to back to back that you don't notice. That's why it feels so strange right now. That's why it feels a lot worse than what it really is. We've had these pullbacks. We've seen, the declines have been in our face because they're big, but the gains have not been in our face because they're small. And as a result, we've got this environment where massive pessimism on a 6% from all-time highs. When things look, when the market doesn't react to what should be bearish, when it reacts bullishly to what should be bearish, that's a good sign. And that's kind of what we've been seeing more and more of in this market over the last couple of years. Is bad news is kind of quickly, it might have an effect, but it's sort of quickly flushed out. So bottom line is, it depends on Washington. If Washington signifies nothing and there's generally status quo, maybe some changes and some identification of some waste, maybe we get 300 or 400 billion of waste that's reduced, not 1 or 2 trillion. Maybe that's just this regular scenario, normal interest rate cycle that would lead to inflation where gold and silver would do very, very, very well. That could still happen. If we do see a massive decrease in government spending, a lot of deterioration in trust in the in the financial institutions, especially, but in the political institutions. I think you have a deflationary environment. I think that could be a recession. That could be a bear market. But one of the things to keep in mind is in the 70s and in the early 1900s, when we saw this cycle, there were multiple minor recessions. There were multiple 20% pullbacks around those recessions. And it was a trading range for a long time. And if that happens, I do think that we should see some inflation. And I think gold miners, the gold stocks really haven't kept up with the price of gold. So there's some potential catch up that those areas could do, the gold miners and the junior gold miners. So there's some opportunities. They're not scoring all that well in our system just yet, but I would expect them to here shortly. So those are definitely some good possibilities. But if we go into a deflationary environment, then that's really not going to be good. Any kind of recession really is probably not going to be good for gold and silver. Another great question. Let's see. We've got a couple more. We kind of addressed a lot of these. Any new questions out there? I'm going to leave it open for just another minute or two. Here we go. Oh, there are some more. Question, is the stability of the dollar in play here? Seems like the global concerns over U.S. actions, economic, political, etc., could undermine the U.S. dollar, ultimately leading not being the reserve currency. Another great question. The reserve currency, first of all, let's understand the reserve currency. Historically speaking, the reserve currency of the globe was the strongest navy. So whoever controlled the seas controlled currency. What that means today is the strongest military. And there's really no question that the U.S. is the strongest military on the planet. I think there could be effects on the U.S. dollar. It'll be negative effects on the U.S. dollar if we see the institutions questioned and sort of the overall state of society questioned. There could be a flight to safety if we see Russia and Ukraine just continues to be interesting and a wild card. China, that their economy is not doing well. The Chinese central bank is printing a ton of money now. It kind of supports the gold and silver. But if there's a flow, again, it matters with flow. If there's a general flow coming from outside the world to into the U.S. as a flight to safety, that will be supportive of the U.S. dollar. If we don't, if there's concern and money starts to flow out of the U.S., then that has pressure on the downward pressure on the U.S. dollar, and would kind of be a early sign that maybe we're on this path to somewhere else being the reserve currency. But at this point, there's not a good alternative to the U.S. dollar, frankly. And I don't think the U.S. military over the short run is going to kind of get knocked off from being the biggest in the world. So I think the U.S. dollar will probably be volatile, but I don't think we're at risk of losing reserve currency. But good question. Over a long time, maybe 50 years, maybe. Another question: if corruption is high, are the DOGE cuts appropriately focused upon the sources of high corruption? Great question. I have no idea. I will say Doge. I've been following this quite closely, and it's interesting. Some of the things that they're doing, what they're really doing is they're creating these maps of payment flow. So, it's a read only. Imagine that you had You were the CEO of Frost Bank and you wanted to analyze all of your employees' spending. You're not going to, necessarily send them more income, or you might fire them. You might, stop money going to them. But I think they're focused on the right sources. I think if you look at the where we're seeing corruption, I think US aid is very much in focus. I think we're going to see a lot. I think we'll see arrests coming from US aid and coming from Ukraine personally. And I think they could be pretty high up. I think this is a personal thing with Trump, which concerns me. But I think after he thought that somebody tried to assassinate him twice, he's going to go after it. And frankly, go for it. If there's theft and fraud and waste and abuse, drag them through the streets. I don't care if it's Bush or Clinton or Obama or Biden or Trump or McConnell or Pelosi. I don't care. I think they're all in the crosshairs personally. And I think they're just doing an analysis of spending and finding crazy things. And I think as it starts to be more public, I think it's going to be pretty shocking. Um, so I think they're analyzing the data and using computer programmers to get read-only access, like the CEO of Frost. If you're going to go through and say, where is my company spending money? And let's say it was an archaic payment system, and you have multiple payroll systems and multiple bank accounts and all this stuff, and you hire the smartest people in the world to come in and say, I want you to tell me where we're spending money so I can understand it and we can make decisions on whether we should be spending it there. That's what Doge is doing. So they're just looking at all of it. I think we're going to see massive corruption in the Department of Defense. I think we're going to see massive corruption in Medicare. I think we're going to see massive corruption in Social Security. We're already starting to see that. I think some 200-year-olds were receiving Social Security payments. I read there was a guy in Louisiana who had stolen, I don't know how many Social Security numbers, and was getting $1 million a year in Social Security from, like, I don't know, 30 or 40 or 50 or however many, 100 or 500 or whatever it is. But there's stuff like that. And then there's other things where money going into these non-governmental organizations, NGOs, that are literally getting laundered. It is literal money laundering going to senators and congressmen and people in government. That is what, frankly, pisses me off. And I think it should make everybody who pays taxes extremely mad. But we have to see, because it's nothing's out there yet, and it could all just be hearsay. It could be narrative. It's that narrative risk is exactly this. Is there corruption? How much is it? Is it true? How do we verify? All that stuff. It's all part of this narrative. So I think we have to go back to data. Good question. Another question: stagflation risk. That's a risk for sure. If we go through a scenario where government spending is decreased, income taxes are decreased or eliminated, economic activity goes up because of that, and then you have a lot of money in the system flowing around at an accelerating pace, that's inflation. And stagflation happens when you get inflation and a recession. So government spending goes down, offset, economically speaking, by an increase in personal consumptions from what was going to taxes. That's inflationary and could be stagflationary. Stagflation could happen with our base case. Our base case being a rising interest rate environment in a slow economy. One of the reasons that rising interest rate environments cause a flat stock market is because at the end of a declining interest rate cycle, you've got very low interest rates. That supports debt. So people take on more debt than they normally would because it just makes sense. You've got a very low interest rate, you can buy more. What debt does is borrows future economic activity and puts it into today. So the combination of this 0% interest rates for 10 years that they shouldn't have been, and then add on top of it trillions of dollars printed by central banks across the globe, that's inflationary. But what happens is that you have this increase of economic activity that happens during the later stages of this low interest rate environment and kind of continues on as the interest rates go up. People are still buying. One of the big things with mortgages last year was, I heard realtors saying, hey, buy a house now. I know it's going to be 7.5% interest, but it's going to go back down to 3 in a couple of years, and you can refinance. Maybe not. That's not the likely scenario. So if we see a big recession, that should pull inflation down, especially if we don't have the printing of money from the central banks. We could still have it. So stagflation is definitely a risk. This is an environment where it really is all on the table. Without potential things out of Washington, like I say, I think bottom line is it looks pretty good. But if we overlay those, it changes things. It really has the potential to change things. And so what do? We look at data, we get non-emotional. We can't make a prediction and stick with it. If we think we're in a bullish environment for the next year and that changes tomorrow we change. We do not want to dig in our heels and become sort of ingrained in a certain scenario. So you have to stay nimble. That means that there could be, there's no perfect system. So, we might de-risk and right ahead of a big market rally. We could increase some exposure ahead of a market dip. That's going to happen. And in this environment, the risk of that happening goes up. But the key, what you have to continually go back to is for individual investors, what's important. For your financial plan, the most important thing is avoiding the big declines, period. Underperformance against the benchmark does not matter to your financial plan. It helps. Big declines are what throw you off. There's the potential for that right now. It's not the likely scenario, but that potential is there from big structural changes in government and society. But we need to stay nimble, always have a little bit of an optimistic outlook on things. I mean, we're investing, so we want to err on the side of optimism, but we want to be real and we'll call it like we see it. We're going to continue to track this stuff. I know Trump is talking tonight, so maybe, I don't know if this webinar is going to be useless tomorrow morning, but we don't think so. And we'll keep watching it. But we appreciate everybody's time today. It looks like we're a little bit long. So we'll send this out tomorrow. Thank you all for joining us. We really appreciate your time, appreciate your business, appreciate your friendship. We'll send this out with the slides tomorrow. And please do not hesitate. If you have questions that we couldn't get answered, please don't hesitate to shoot me an email and ask those questions. Or give me a call. And appreciate you. Invest wisely. Have a good evening.